Hey there, everyone. How we doing out there? Dave Keller here with Market Misbehavior, here to hopefully help you feel a little bit better about what we observed today in the markets. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. It's actually beautifully sunny here. It was pouring rain about an hour and a half ago. It's cleared up here in Redmond, Washington, and we're looking pretty good. I hope you see some sunshine wherever you're at as you lick your wounds and recover from what happened today. We're going to talk about this obviously pretty significant sell-off here on what may be known as Black Friday. And we'll also talk about some implications going into next week. Of course, we're going to spend some time ruminating on a lot of these charts to produce our weekly flight plan, which is our main report that goes out to our Market Misbehavior Premium members. So if you feel that need to have greater help and assistance through this period, our Market Misbehavior Premium memberships, no better time to get some help kind of navigating through difficult periods. You can find more info at marketmisbehavior.com/premium. Before we get to what happened today and some initial thoughts, I do want to let you know we posted a choose your own adventure style video on our YouTube channel just about an hour ago. I'd encourage you to check it out. We laid out 4 different scenarios. I kind of sketched this out to release today, not knowing ahead of time today was going to be the day where the technology sector is down over 5% through the course of the day, almost 7%, it looks like. So you have the opportunity to vote from a super bullish scenario to a super bearish scenario or one of the in-between scenarios. You can find that on my YouTube channel. Please take a look, explore some of the different possibilities that we could see between now and late July. Cast your vote and then see what some of the fellow viewers have in mind. It's a great way to get yourself out of your preconceived biases and open yourself up to different perspectives, which I would argue one of the most important things you can do as an investor. All right, here's the damage, folks. I'm guessing if you're watching the show and if you follow my work, you've probably been following the markets today and watching the red on your screens. Today was not as bad as other days I've experienced in the market, but I vividly remember a day early on in my Fidelity career. This is 2008, kind of the meat of the global financial crisis. And I remember standing in one of my analyst rooms, offices, and there was another analyst there and me, and none of us were talking. We were just staring at the Bloomberg monitor, just watching the red appear to get brighter and brighter. So you could feel the heat coming off the monitor, with how much red there was on the screen. And no one was saying anything. We're just kind of looking. And at least in my mind, it's like everything's going to be different after days like today, I feel like. And it certainly has been. So let's talk about what happened. We'll try to put it in perspective. And again, this is going to be quick because I've got 6 really great questions from you guys over this week, including the first question, quick preview from Mrs. Dave Keller. This is from my wife. When I went down for a coffee break earlier today, she dropped the first question on me, and I'm going to have that be the first question in the episode. All right. S&P was down 2.6%. That takes us back below 7,500, back below 7,400. We're at 73.83 and change. That's down 200 points on the S&P. That's certainly one of the biggest drops we've seen in quite some time. The Nasdaq composite down over 4% to 25,700 and change. That's obviously one of the biggest drops we've seen in the Nasdaq. The Dow only down 1.4%, being the big winner today. And that's because some of the value and really more of the defensive sectors actually did okay today. Down the road, we can see mid caps and small caps. Nothing was immune to this. Even the small cap indexes, which have been generally decent, have struggled. And if I remember right, large cap value, I think, was the best sort of style box today. The VIX, and this is important because we've been talking, I feel like every episode I've been saying, hey guys, the VIX isn't above 20, so let's not get too worried. Bad news is the VIX is above 20. It popped above 20 finally right around 3 p.m. Eastern, started the day around 15.5. As the day progressed, it kept getting further and further. And this is where the options market is starting to price in, obviously, some significant swings. And so the VIX above 20, that's the red flag. We talked about the Hindenburg Omen. We talked about the Titanic syndrome 2 weeks ago. Talked about the Hindenburg Omen last week and then confirmed again this week. Today, we're going to tell you that the VIX is back above 20. So when I think of like the checklist for market tops, we seem to keep checking some of those off. Not all of them, right? So we haven't had things like divergences, like breadth and momentum divergences, but I'm definitely some signs that I've often been very thankful that I've followed that have told me to be concerned. This is one of them. The VIX was up 6 points today. That's one of the biggest moves in the VIX you're probably ever going to see. I mean, this was a significant rotation. All right, elsewhere, rates went up, and I want you to put a bookmark in that in your brain, because we're going to come back to that in the Q&A portion of the show. 10-year yield's just above 4.5% to finish today. The long bond yield ended right around 5% even. Bonds sold off along with stocks, and so rates are popping higher. We had the jobs number first thing this morning, was really good, and the market went down on the equity side and on the fixed income side. The dollar's up. That's another one of those red flags we talked about as a sign of potential flight to safety. So that's all checking the boxes. Precious metals have generally been following stocks. We've been tracking the deterioration in gold, talked about how we've been lightening up in our own gold position because of the weakness. Last thing was the 200-day moving average on the GLD, which is broken into today's close. The GLD down 3.6%. Silver prices down over 8%. Crude oil prices coming down, as were natural gas. The whole commodity complex was down pretty good today. Unfortunately, cryptocurrencies all down pretty good. What's really fascinating, though, is Bitcoin is starting to currently rip higher. It did go below 60,000 and is currently took a big left turn and started to pop higher here. It's currently trading just below 62,000. What's interesting is after a day like today, you often have to wait until Monday's open, or really, Sunday evening when you get the futures open. You can start to see some macro color. Now that we have cryptocurrencies that trade all weekend, obviously a lot less liquid, but we can track, sort of what happens over the next 24, 48 hours and see if there's, if it's despondent or optimistic. We can see all that on the chart of cryptocurrencies over the weekend. Bitcoin back above 60,000 is good because we got below that earlier today. That's obviously a significant drop. Ether prices took an absolute tumble today, down about 9% today, trading just above 1600, that is. So very few things up today. So on a day like today, like what was actually up, and that tells you how bad things were. The VIX, interest rates, and the dollar. And those are the three things that you've said of all the front page stuff on stock charts. What are the three things that would be the biggest red flags on a market in a risk-off condition? I would say a spike in the VIX, interest rates popping higher, and the dollar going up. Those are all like safe haven, people are nervous kind of moves. It's all there. Hey, it's not all bad today. And I'm going to say that a couple times. Listen, on days like today, I will tell you, the good news is I've been through a lot of days like this. And depending on how much gray or white you have on your head at the moment, or the absence of hair, if that's an issue you're faced with, the longer you've been in the market, the more scars you have. It's from days like today. But the good news is the market tends to recover from everything. We're still not too far off of all-time highs. Let's keep that into proper focus. And let's celebrate the fact that five sectors out of the 11 were actually up today. Consumer staples were up 1.7%. Utilities were up 0.9%. Real estate up 0.7%. Healthcare up 0.6%. Financials were up a little bit too. Now, why are those first four sectors so important? Those are the four defensive sectors. So I tend to think of the sectors in three buckets, and there are different ways to think about this. Is my kind of oversimplistic way of summarizing it. You've got growth, technology, communication, services, consumer discretionary. They all got crushed pretty good today. You've got the cyclical or value sectors, industrials, materials, energy, and financials. Those did a little better, but still not good. Then you have the defensive sectors, staples, utilities, REITs, and healthcare. Those all were up today. Not outperformed, they were up. They actually gained value. So what this tells you is investors were selling out big time out of technology, as you most likely have noticed, but they weren't rotating out of equities and going somewhere else. They were rotating into other things. This is a thing that is a theme that JC O'Hara and I talked about on the Market Misbehavior podcast. I think that's probably going to go out to you tomorrow morning. So keep an eye. If you listen to stuff like that over the weekend, look for a new episode of the Market Misbehavior podcast. JC O'Hara had some really good thoughts about sort of leadership rotation as opposed to risk off, right? So we're going to defensive sectors, but at least we're still in equity. So that's something, an emerging theme we'll talk about. Breadth wasn't great today. I'm going to talk more about that with premium members over the weekend. Looking at the factors here. So these are not factors. These are the kind of 9 Morningstar style boxes. Large cap growth, the worst, down 3.8%. Large cap value, the best, up 1.1%. On the Magnificent 7 And friends, everything down. Broadcom, the worst, down 8%. So Broadcom gapped down yesterday after earnings, but closed above the open. Today sort of makes you feel like yesterday was just a dead cat bounce for one day on those names. And then now starting to rotate lower. Best performer of this basket was Alphabet, down 1%. So no denying this is a pretty big down day. I mean, is this a big bear market? Like anyone that tells you that, it's a guess, right? I mean, I can guess and tell you, yeah, I think the market's probably going to go down over the next 4 weeks. That is a guess, right? And I feel like the financial industry is full of people that have a guess and frame it as a fact. It's an opinion or a guess framed as a well-researched fact. It might be well-researched, but we're all guessing. I mean, I think from a trend following perspective, we haven't made a lower low yet, right? We haven't undercut the May low. We have undercut the 21-day exponential moving average. That's not nothing. That's an initial stop. So, for me, it's like we've hit the initial trigger. Definitely. A lot of stocks, we talked about the chandelier exit. Has that hit? Absolutely. So in terms of like an initial sign of weakness, I think that's all happened. The question now, and this is what you deal with in any sort of drop after a big uptrend, is, how deep is too deep? How far down is enough that you start to think, all right, this is now something really risk off where I want to get defensive. My market trend model is still going to be bullish on the medium term time frame, even after today's drop, because it really wasn't much relative to the incredible trend we've had off of the March lows. Risk measures are still okay. We're still over half of the S&P names in a bullish point and figure chart. We're over half of the S&P names above their 50-day moving average. So for now, I tend to label this as a garden variety correction, right, from a technical perspective, until we see evidence of something more significant. And what we've not seen yet is breakdowns in momentum and breakdowns in breadth. Those two things are actually still pretty decent on a lot of charts that we would review together. All right, we're going to go from here into some Q&A. And again, these questions all came from people like you over the last week or so, sharing questions and asking things that are on the top of your mind. And again, one of the things I learned a long time ago is I love people asking questions and I love answering them. That's why I've tried to build a business built on my ability to try to do that and enjoy the process of doing it. So please, I have to tell you, there are no such thing as a bad question. I'm open to anything technical, behavioral, or elsewhere, and I will do my best to answer your questions. You can drop them at any point during our live streams that we do every trading day, or of course on our YouTube channel. Just use the comments section there. And here are some questions I've hand selected starting. And I'm not kidding, true story. My wife, about 5 hours ago, I went down for a coffee break and she said, honey, what happened today? Wasn't that good news? Shouldn't the market go up? Even so, again, talk about the anecdotal evidence. Well, my wife, who is not an investor type, but loves what I do and loves joking that she understands more about what I do than she probably does. When she asks about something market related, I know it's serious. So Mrs. K got into the mix today. That tells you how bad today was. So she was asking this because she saw the headline that the jobs number was really good. And so she's like, what is going on? How can the market be going down if the news was good? And this is a common issue. I even saw the president put out a social media post about this particular thing. Market should be going up. Jobs are good. Which you have to, the moment you realize that good news does not always mean good for the markets. The moment you get to that point, things are going to make a lot more sense, right? I remember thinking if jobs data is good, that means the economy is probably growing. That means market should be going higher. Not the case, right? And so I was always taught buy the rumor, sell the news, right? When, something like this, it's one of those good news is bad kind of situations, right? The market's been going up for a number of different reasons, but part of that story has been this idea that the Fed has room to cut rates, right? Or more recently, maybe that the Fed will keep rates steady because lower rates just tends to be better for the markets. That means cheaper borrowing costs. That means companies that need to borrow money to grow can get it more easily. That means consumers, it's less expensive to borrow money to buy big ticket items like a house or a car. So lower rates tend to spur spending and spur consumer activity and spur a lot of action in the economy. So when the jobs data came out so strong, it was so strong that it kind of takes rate cuts off the table. Like, I don't know how you could expect that the Fed would be in any position to with a straight face cut interest rates, given the fact that the jobs data is so strong, right? When the economy is growing, when the jobs data is strong, that's when they need to start thinking about hiking rates, because they would need to make things, they need to slow down a little bit because they don't want inflation to get out of control. And so there's that dual mandate that they have about, maximum job growth, but then keeping prices in check, that are often conflicting, which is why it's an almost impossible role that they have, that dual mandate. So yes, the jobs data was better than expected. Yes, this basically takes rate cuts off the table, and rate hikes have already been started to be priced in. The other thing you have to remember is this market has been growing a ton based on the expectations of future earnings growth of all these growthy companies, right? Semiconductors and other technology, more AI types of names. And the problem with that, as I go to the chart I actually want to show you, the problem with that is interest rates, right? So what happened today was stock sell-off, bond sell-off, the 10-year yield starts to pop higher. So we had a big move higher in the 10-year yield. And so the 10-year has been generally making a pattern of higher highs and higher lows since the February low. When rates go up, what that also means is that when you calculate how much a growthy company's future earnings are worth, this is what you're taught. If you get like your CFA designation, you learn that the interest rate is one of the most important parts of that calculation, about how much the future earnings growth is worth today. So when interest rates go up, that basically means the company's future earnings are less valuable, which means I should be paying less for my stock right now. And so all of these technology names have been going higher. As long as rates stay low, you can justify that those future earnings are more and more valuable today. But if rates are starting to go higher, which today was a pretty, I think, clear reaction to the jobs number, all of a sudden those future earnings are less valuable. So it kind of means we should be valuing growth stocks less extreme. That's not what you want to see in a growth-led bull market. So that Mrs. K, that's the answer. And I did explain this to her in simplistic terms earlier today, and we had a great explanation. I told her, you know what, I'm going to make that my first question today. So, honey, there you go. Thanks for the question. All right, the rest of these, I promise, are not from my wife, but they're from all of you. Question 2, where there'll be a rotation to laggards or a resumption of the bearish market. And I had a couple different questions sort of along these lines, and I appreciate a number of you asking about that. And that, honestly, that's an unanswerable question. I mean, anything I can tell you now is sort of speculation along those lines. But that I would say is a very meaningful way to think about this current environment. I mean, what we haven't seen is a big rotation out of equities into other things, right? You haven't seen a big rotation out of equities into precious metals, right? Gold and silver are moving very similar to equities. You're not seeing a rotation from stocks into bonds, or else the TLT would be moving up on a day like today. We're seeing basically money stay in the equity space in a lot of ways, but just rotate. And even today, again, which was a really bad day for the benchmarks, you have to remember the benchmarks are not the market. They are an indication. They're in an index. Each of these are indexes that track some subset of the equity markets, and they are meant to infer what the markets overall did. But while the S&P was down 2.6%, and while the Nasdaq Composite was down 4.2%, and the Nasdaq 100 was down 4.8%, the Consumer Staples ETF, ticker XLP, was up 1.7%. If we look at individual names, let's say like even in the Dow, Procter & Gamble was up 4% today. Coke, one of the beverage companies, with a bullish harami pattern, up 3.5%. Travelers Insurance in the financial sector, insurance companies, more the defensive areas of financials, up 3.4%. Johnny John up 2%. So, and again, this is just a handful of Dow Jones names, but even in the Dow, you had plenty of stocks that were actually up today. So this is one where the benchmarks, we have to remember that our equity benchmarks in the US are very growthy, right? The Dow Transports Index was up today, as was the Dow Utilities Index. So not everything was bad. It's just the stuff that weighs the most on our benchmarks was down the most. And that's what kind of creates this crazy skew in the heat map, right? I mean, if you cover up technology and you cover up Meta, Amazon, and Tesla, it wasn't a horrible day. I mean, it certainly was a day when a lot of names were down, but there are plenty of things that were actually up just fine today. So this is one of those times where if you just look at the S&P and its percent change, you look at the QQQ and its percent change, you're going to have a very specific feel. It's a big drawdown in some of the names that are already up a ton. And even though AMD is down 10%, it's still up a ton year to date. I mean, it's still up an absolute ton percentage-wise, even dropping 11% today. So I would say for now, there's no real sign that it's a rotation out of equities. Even on a day like today, the heat map has a lot of green on it. So it's more of a rotation to more defensive positioning. Where I think we need to start getting concerned is if that continues, eventually the defensive sectors really start to outperform. You saw that today. And eventually people start to want to get out of equities altogether and go somewhere else. And that's when some real significant declines can start to occur. That's when it's more of a cyclical decline and not a tactical decline, to use two adjectives that I think frame it up pretty well. All right, next question. Although we know it's always a good time to own good charts, and thank you for listening to the tagline at the end of every episode. I appreciate that. What combination of factors would tempt you to fade a chart and take a contrarian position? That's a really good question. So I usually answer something like this by saying that could be an entire day-long, event where we talk about that, and maybe at some point we'll do an offsite market misbehavior nation here somewhere in the Seattle area. Come in town, we'll talk about this and look through some examples and discuss it as a group. That'd be kind of fun at some point. But for now, I'll give you the quick version. And we did a webcast with this general topic last week that a number of you tuned in for, and I appreciate you doing it. So I'll give you like the quick version, right? And I would say in your question, right, you said, what combination of factors would tempt you to fade a chart and take a contrarian position? And I would be careful how you're phrasing your question. I think misses some of the opportunity you have as an investor. Individual investors, I find, too often think in very binary terms. I either own Apple or I don't. I'm long or I'm short. And they think of it as a binary thing, right? I'm playing the upside or I'm playing the downside. A more sophisticated way to think of your exposures, to think of your exposure to a particular name. Think about what percent of your assets you are putting into Apple or whatever the particular stock is. And if things are looking good, your position's going to naturally grow, but maybe you add to that position on the way up. And if the position starts to not do well, that doesn't mean you sell and go 100% short necessarily. Maybe it means you lighten up on a position. Maybe it means you reduce your overweight. Maybe it means you hedge it in some way using options or something like that. So remember, you have a lot more flexibility in terms of exposure you have to particular stock than just am I long or short. And I would encourage you to kind of explore that as a spectrum and less as a binary decision. So having said that, what are some of the things that would tell me if I was long Apple and I don't have a position in this particular stock, but I'm sure a couple of ETFs that have exposure to this in some case, what would cause me to change a position? So, I mean, again, horrible day for the XLK, horrible day for the Nasdaq. Apple's still a really good chart. I mean, arguably an exceptional chart, right? The price is not too far off a new all-time high. The moving averages are all sloping upwards. So again, in terms of context, there are some charts that if this sort of move continues, will start to look worse and worse for sure. But a lot of these charts still don't look that bad, even ones that had a pretty decent pullback because they've had a run so far. So what would cause me to change it? Two indicators that have been my go-to like initial signals to start to lighten up, or at least consider doing that. The one would be the 21-day exponential moving average, which is the green line on most of the charts that I show you. That's a very short-term moving average. It's an exponential average, which means it's pretty sensitive to fluctuations in the underlying price. And it's designed to follow the trend up and give you an initial sign when things are changing. That, along with the chandelier exit system, which is another indicator built into stock charts and a number of other platforms as well, that was created or popularized by Dr. Alexander Elder in some of his books. And that's based on average true range. Those are the two indicators that are kind of my go-to initial stops, right? I have something that is a long position that's been working. I like to think of one of or both of those as an initial sign. After that, it gets a little more complicated because then I want to start to assess conditions a little more deeply. Then I might use Fibonacci retracements. Then I might think about, Are we finding support at the 50-day moving average? Then I might look at momentum and see if the RSI is holding 40 on a pullback. Because once you've determined that the stock is pulling back, the question is, how much is okay? How much is still just a pullback within an uptrend? And like the RSI holding 40 for me is often a really good way to stay in charts that are working well. And if that doesn't hold, I need to start to think more differently. So that's the way I would answer that. Number one, think in some broader terms on your exposure. But number two, think about sort of like that initial warning sign. And for me, those are two indicators that I found pretty helpful. We'll continue on with 3 other great questions from all of you guys from the last week. Before we do so, quick shout out to one of our partners, EPS Momentum. You can go to marketmisbehavior.com/EPS for 30% off your first payment on any new subscription. They do some really good work with sector rotation and top-down macro analysis, but I think where the platform really shines is from the bottom up. This has become one of my go-to platforms, scanning for ideas, looking for big moves on big volume, looking for improving momentum characteristics, but all with that earnings overlay. I want to make sure that these companies are actually making money. I want to make sure that the expectations for future growth are still there. And this has allowed me to combine those two in a meaningful way. You can find more info and see what I'm talking about at marketmisbehavior.com/EPS. Again, use that link. You'll get 30% off your first payment on a new account. Thanks again, the folks at EPS Momentum, for supporting Market Misbehavior. Next question, would you buy a stock with RSI and MACD going down, but price looks to be at a support level? Would your answer depend on if the RSI is still above 40 or if the MACD is above or below the median line? So awesome question. I touched on this a little bit with the previous answer about, what happens when you break that initial level of support. Would I buy a stock with RSI and MACD going down? So the answer is absolutely, right? I'm trying to get like a good example to show this. So hold on. So here's RSI. I'm going to add MACD because that's what you asked about. I actually use PPO more often, which is like MACD, but it uses percentages instead of dollar terms. Similar methodology. It's just, I think it's just a nice, meaningful tweak to a really good indicator. So I use the PPO on stock charts, but MACD is very, very similar. So I'm happy to use it. I'm happy to use it here. So, the question, would I buy something with the MACD and the PPO going down? Absolutely. United Healthcare is one of my, charts out there. I have a list of like good charts I was looking at earlier this week, and UNH was on there. What you have to remember is when a stock is starting to improve, when it pulls back, even a healthy pullback within an uptrend, we have to remember, right? A stock just doesn't go straight up from point A to point B. You have a move and you have a pullback, a move and a pull. That's kind of the general progression. So those pullbacks are often really good opportunities to buy into the dips, right? Buy into strength and ride the next leg higher. But during those pullbacks, almost undoubtedly, the RSI is going to be going down and the MACD is going to be going down. And that's just the nature of how those indicators are calculated when you have a stock that's even within a strong uptrend and pulling back a little bit. So what I would often do then is look at like the weekly chart where I bet the MACD is probably still going up because this longer trend is still pretty good. I can actually confirm that. Here's the weekly chart and the MACD's, just fine. So looking at multiple time frames can help you understand, all right, in the short term, it's pulling back, but on the, longer term, it's still a strong uptrend. I can see that because the daily MACD is going down, but the weekly MACD is going up. So yeah, and so this is the type of chart I think is a fantastic setup. Long term, good uptrend, good breakout, pulling back to the 21-day EMA. That's often a great opportunity to buy the next leg higher. So for sure, things that would tell me, this is pretty bad. I think you hit on it, right? RSI goes below 40. That's usually not good. MACD line going below 0. That usually tells you, all right, it's something more significant. So I think keeping those types of things in mind can be helpful as well. But I think UNH is a good example to see why and how you might be okay buying stocks where the RSI and the MACD are going down, because it's just a short-term pullback within a long-term uptrend. Next question. When running your 13-week high scans, do you put any weight to the scooter value? That's the stock chart's technical ranking on stock charts. While higher values have proven themselves, could the lower value breakouts have more upside potential? I see what you're saying. So yeah, so if a stock has a high scooter ranking, this is the stock charts technical ranking. You can see that on like United Health Group here. It's scooter large cap. So there's different rankings for large caps, mid caps, small caps, then a separate one for ETFs, a separate one for industries, and then separate ones for like London and India. So each kind of universe has its own scooter ranking. So it's ranking it against its peers, basically. So this is 79th percentile, and it goes from 0 to 100. So that gives you an idea. And then something like a Micron, probably, rates, Micron 99th percentile, because it's had a really good uptrend and a lot of strength going into this week. So your question is, so the higher values, they've probably already proven themselves. And I think that's very, very true, right? So if you have a breakout with the lower scooter ranking, could that have more potential? I think you're onto something really interesting, right? What you have to remember is if a stock has been kind of sideways and then just starts to rotate higher, like UNH doesn't have a very high scooter ranking because it's not been in an uptrend for that long. So the trend following methodology that's built into the scooter ranking, it's multiple time frames, all based on price momentum, number of different indicators on different time frames. But stronger charts are going to tend to score better, right? It's a trend following mechanism. So something that's just starting to break out, the scooter ranking is not as high. And so what happens is when you scan for 13-week highs, which is a scan I run all the time, you find charts like UNH that are just starting to break out. You find things like Micron that have been going up for a ton, right? So it's on the new highs list all during this period. And most of this time, it's making a new 3-month high. So it keeps coming up on the list. But this will be on the list with a very high scooter ranking. The UNH will be on a list for a low scooter ranking. So do I filter on scooter rankings? I do not. Do I kind of intentionally look for things that are not already way going vertical and are things just starting to emerge? Definitely. One of the ways you can do that is look for a lower scooter ranking. So I think that's actually a really good way to think of it. So what I often do is I run that scan and then I sort it based on scooter rankings in ascending order. So you start with the lowest numbers. These are the stocks that are just starting to improve out of some basing pattern. Great question. I appreciate the wisdom in that question. All right, last one, then we'll call it a week and hopefully decompress from this week. And I hope, however you celebrate responsibly. The sun will come up tomorrow. I promise it's going to be okay. But I hope you can find some ways to distract yourself from the carnage. Dave, do you use a different system to analyze ETFs versus stocks, or do the same 21-day, 50-day, 200-day levels hold true? So the short answer is, if I'm looking at United Healthcare, I'm looking at the SMH, or I'm looking at IGV, which is a software ETF, or I'm looking at Royal Caribbean, I use the same combination, the 21-day exponential moving average, the 50-day simple moving average, the 200-day simple moving average. Those for me have become kind of go-to things. And for stocks and ETF, I think the coolest part about ETFs is they basically trade like a stock. The patterns are often very, very similar. Even things that cover other asset classes, just the nature of how they're traded means you get a pretty good, most likely a fairly liquid amount of data to consider. And so that's kind of my go-to chart for stocks and ETFs. When I'm looking at other things like the 10-year treasury yield, I have a different set of charts to look at that. When I'm looking at spreads or ratios, right, like a 2's10 spread, or like the relative performance of this stock versus this other stock, or like a pairs trade, then I would not use this particular moving average combination. For me, this is sort of a tradable security that's a stock or ETF like thing. This is kind of my go-to. Now, what you're getting to I think what you're implying is, should we be thinking about things differently? And I think what you have to remember is there are certain things that kind of make more sense for stocks or ETFs, right? Like earnings are going to be a much more, market moving factor for individual stocks, and a much greater risk. Right? One of the benefits of ETFs is you're diversifying away from just one company and their crazy moves around earnings. So the way that earnings are reflected on the chart are going to be different. A lot of times you might have a lot less gaps, just because ETFs generally can be a little less gappy depending on what you're looking at. But having said that, for me, I always start with this as a go-to chart. Then I have other charts that I look at, right? So like for an individual stock, maybe I look at volume a little bit more. So indicators related to volume might be more part of my my toolkit. With like a broad ETF, maybe I'm going to focus a little more on relative strength to other ETFs and other asset classes, right? As a way of thinking of it. So I would say the chart I look at after this, that's where my analysis might diverge a little bit. But as a front, sort of an initial look, I think it's pretty good to have one chart for stocks and ETFs. This is my go-to. I mean, this is not saying that you should have your own, you should be using this chart, just that you should have a chart, have a starting point that gives you a good sense of what's happening on the chart, and then go where you need to go to continue your analysis. Folks, that'll do it. Thank you guys so much for tuning in live. I did see a random question or two in there. I'll snag those and pop those in the mailbag. All of those questions, except the first one from Mrs. Keller, came from all of you watching the show in the last week. So keep them coming. If you ever tune into our live stream, you can drop questions as we go. If you watch the show on our YouTube channel, you can drop questions there as well. Friendly reminder, we just released our latest Choose Your Own Adventure video on our YouTube channel, laying out 4 scenarios for the QQQ. Really good time to have a proper perspective and think about what might happen next week and the weeks to come. So make sure you check that out. We'll be back on Monday. In the meantime, have a wonderful, joyful, restful weekend. And remember, it's always a good time to own good charts. Take care, folks.